From emails to reports and project proposals, it's hard to meet the demands of today's competing priorities without some help. Grammarly is the essential AI communication assistant that boosts your productivity at work so you can get more of what you need done faster. Just a few clicks can tailor your tone and writing so you come across exactly as you intend. Get time back to focus on your high-impact work. Download Grammarly for free at grammarly.com/podcast.
Frequency Podcast Network. Stories that matter, podcasts that resonate.
Well, we're into it now, a global trade war. And we knew it was coming, but perhaps not to the extent to which U.S. President Donald Trump unveiled the so-called reciprocal tariffs this past week.
Our country and its taxpayers have been ripped off for more than 50 years, but it is not going to happen anymore.
Those tariffs ranging from a baseline of 10% to more than 50% for a whole host of nations, 65 countries that saw reciprocal tariffs, including China, Vietnam, Cambodia, and India.
We will charge them approximately half of what they are and have been charging us, so the tariffs will be not a full reciprocal. I could have done that.
Now, the problem, many of those countries that are now facing these huge tariffs are where American companies currently make many of their items. But the U.S. president believes they'll just bring all of that work and those jobs back to America.
I think it's going to be unbelievable. The thing that people have to talk about, we're up almost to $7 trillion of investment coming into our country. And you'll see how it's going to turn out. Our country's going to boom.
Well, unfortunately, the market wasn't buying what President Trump was selling. Global financial markets plunged over Thursday and Friday's trade, some of the biggest drops since the outbreak of COVID in early 2020. Some of the U.S. benchmarks and even the TSX on Bay Street are now into either a correction or full bear market, down 10 to 20% from the recent records. And all this has transpired, really, since the record high back on February 19th. It's dropped substantially in very short order. And while the Trump administration was calling for patience, admitting the massive shift in U.S. trade policy will cause some short-term pain, well, in the long run, you heard the president, the American economy, he thinks, will boom. I'm Mike Eppel, and on In This Economy podcast, we're looking back at the upheaval on the markets and trying to make sense of it all now that we've actually had a moment to exhale. Joining me is Randall Bartlett, Deputy Chief Economist at Desjardins. Hello there, Randall. Let me start by just first asking you, how are you after this past week?
I'm getting a little tired, not gonna lie, but it's certainly keeping us busy. All the market action that's coming out of this tariff announcement on Wednesday.
I think part of the issue for economists like yourself, or just for the layperson who was watching the Rose Garden event on Wednesday, was sort of the haphazard nature of how it was all put together. And we had Bristol board lists and countries on that tariff list that, and we found out after the fact, were uninhabited places. Only penguins lived on these certain islands. And it seemed to be kind of slapped together. And that's part of the issue. There was no telegraph, and we had to wait to find out if Canada and Mexico were even added to the reciprocal tariff list, and that wasn't telegraphed either. So it was, if nothing else, a very interesting way to announce a change in, well, a 100-year trade policy and turning it on its head.
Yeah, I mean, this is not the haphazard approach to economic policy that most U.S. presidents and U.S. administrations have taken in the past. What we saw on Wednesday was it was quite unique, and I think will be a historical moment in terms of both the very direct attack on the global trading system to the detriment of not just citizens outside of the United States, but the economic detriment to American citizens as well, and with the knock-on implications we've seen in financial markets also. So it's been a bewildering week, certainly, for economic policy.
And if you want to get, to persuade support for a change of trade policy to this extent, wouldn't it be in your best interest to get your biggest companies who you are trying to perhaps lure back to the United States, because that's the end goal here, is to recover U.S. manufacturing, which has been offshored or has gone to lower cost jurisdictions, the likes of Nike or Apple or what have you. Wouldn't it maybe be a good idea to talk to them first and have them with you on this to when you're laying out this strategy?
Well, I mean, I think this is an evolution of the tack toward populist politics that we've seen, not just in the United States, but globally as well. The antagonism toward large companies that are based in your country, and vilifying them relative to the populations that you believe you've been elected to represent. And so I think that's all part of this process. I think it's also reflected in the fact that the president has said that he doesn't look at financial markets and what the outcome of these policies are on market. He doesn't, that's not relevant to him. And so I think that's a reflection of that as well, that really is sort of living in this bubble that he believes he's serving the people who elected him to office. And he ran on this, to be fair, and he won't be thwarted by the views of their CEOs and global investors and the educated, affluent elite in the United States. So it's very much a focus of he thinks he knows best and what direction the country needs to go, and there's going to be some pain on the way. But at the end of the day, he thinks that pain's going to be worth it for the long run of the U.S. economy.
I want to pick up on something you said there, though, about the fact that he says he doesn't watch the financial markets. In the past, that's all he's talked about. And the fact that, the initial response was, okay, we're looking at tariffs on China north of 50% and Vietnam over 40%. But this is just maybe if you go by the art of the deal, it's just a way to negotiate. So is that part of the issue here where, again, the contradictory signals and the fact that we don't exactly know what the strategy is, which is in turn leading to the market chaos that we saw over Thursday and Friday?
Well, I think that's it. I think the process for making these sort of decisions has been so haphazard and uncoordinated and uncertain, at least to any observer that's trying to understand what the rationale could be driving this, that it's very difficult to come up with any sort of strategy or sense that this may be the end of this, or this may be coming off, or this may be a negotiating tactic or something along those lines. It's very difficult to get that sense. And so as analysts, investors, and companies are trying to get a sense of what earnings are going to look like going forward so they can value these companies, it's very difficult to know what that's going to look like. All we know is that it's going to be more expensive now for those companies to produce products either in other countries and then sell them into the U.S. or move manufacturing back to the U.S. Manufacturing is very expensive in the U.S., hence why a lot of their U.S. companies moved, especially their labor-intensive manufacturing, to other countries that have cheaper labor and still have a lot of the higher value-added manufacturing in the United States. But moving the lower-end labor-intensive manufacturing back to the U.S. is just going to continue to increase costs for U.S. consumers. Now, it may obviously create some jobs, but what we've seen in the first Trump administration was that on net, manufacturing jobs were lost because of these measures. And manufacturing that came back to the U.S. was highly automated and employed more engineers and software developers than it did low-educated workers on the factory floor.
And the fact that it takes time to repurpose your factories or build a plant, I mean, that doesn't happen overnight. I mean, that could take, years. And if you're again, we're still we're still, in the first week of this, really. But if you're a corporate executive trying to figure out, where to invest, is this a situation where you say, maybe I'll just wait it out? I mean, policy, we got within 2 years, you've got the U.S. midterms and a bunch of other things, and maybe Congress or the Senate could get involved. But at the same time, it is going to raise prices for consumers. There's just no way of getting around that.
No, I agree, and it seems that the Trump administration is the only group of people talking about tariffs who thinks that that's not going to be the case. That somehow it's going to actually, have very little impact on inflation. but they're living in this bubble that seems to be sort of reinforcing because they're repeating the same falsehoods to one another over and over and over again. And so it's really it's going to be a challenge for the American people. And to your point, it's not just a question of hitting earnings for these companies in the near term. That investment, if the Trump administration wants them to reshore to the U.S., is going to take hundreds of billions, if not trillions of dollars in investment that may not have otherwise needed to be made. And so that's all going to come out of earnings and out of profits of these companies. So that's going to reduce their value, but that's also going to hit people's 401ks. So it's not just a question of what it means for people's for inflation and their day-to-day budgets. It's also what it means for their long-term savings and for their retirement savings. I mean, this is hitting Americans coming and going every which way, and it's hitting the rest of global citizens as well. It's just a mess. It is an absolute mess.
It's more challenging than ever to meet the demands of competing priorities that work throws our way. From emails to reports and project proposals, we need help to get it all done. Grammarly is the essential AI communication assistant that boosts your productivity at work, so you can get more of what you need done faster, no matter what or where you're writing. Grammarly sets the standard for responsible AI and equips you with the best tools to do your job, like AI-powered features that help you write and edit quickly everywhere you write, or tone features that help you communicate more confidently. Just a few clicks can tailor your tone and writing so you come across exactly as you intend. No wonder 93% of professionals report that Grammarly helps them get more work done. Let Grammarly take the busy work off your plate so you can focus on high-impact work. Download Grammarly for free at grammarly.com/podcast. That's grammarly.com/podcast.
Even if you thought that tariffs were a good idea, I think the piece of the puzzle that may be missing here is, and again, the claim has been, if you're tariffing, you're bringing all this money back to America, back to the government coffers. But then if consumers are being hit by all of these added costs, I mean, car prices are going to go up, the day-to-day items are going to go up. Do you at the same time, should they have not perhaps announced a sweeping tax cut? Because I think that's what they want to do anyway. Would that not offset some of the damage? Again, if you think the tariffs are the right way to go.
Yeah, I think that is what they're hoping is going to happen, that both there'll be an extension of the existing tax cuts that are set to expire around the end of the year, but also there will be room created through additional revenues raised by tariffs to further cut income taxes. However, I mean, the irony of the extension of the tax cuts is that they were disproportionately benefiting the wealthiest Americans. And so the people who are going to be paying the price of higher inflation tend to be lower and middle income households who aren't going to be benefiting from this extension of tax cuts. Now, there may be another tax cut in the work if they have those revenues, but don't forget the last time they did this, they had to pay enormous subsidies to farmers and other people adversely affected by the higher tariffs. And so, you have to wonder, okay, they're going to give out subsidies to affected people. They're going to extend these high income tax cuts. And then it's like, what's going to be left over for these further tax cuts, especially when you have a higher unemployment rate because of the fact that inflation's higher. You have all these companies whose profitability is getting hit. You're losing personal income tax revenue at the same time just because of a weaker labor market and economy more broadly. So it is a policy designed by almost its intent to make the U.S. economy smaller, more isolated, and make the tax base of the U.S. economy smaller as well.
There has also been a theory, though, and I don't know how much credence we should give to it, but then when I see what's actually happening for certain components of the market, that, in the game of 3D or 4D chess, what they want to really do is to crater the economy and bring borrowing costs down. And I watched, you did too, the Treasury market this week saw a sizable drop for yields in the U.S. And again, the proponents are saying, aha, the strategy is working, that this will help them afford, for lack of a better description, their 36 or $37 trillion of debt that they have to pay with lower interest costs and subsequently bringing the price for oil down, which is, a de facto tax break for drivers because the price of the pumps is going to come down.
I think you need to work pretty hard to get there, to be honest. Let's call that the stable genius theory, that beneath all of the madness, there's this brilliant stable genius that's working 10 steps ahead of the rest of us to manufacture all of this. Maybe, sure. I mean, the probability is not zero of that, certainly. But at the end of the day, the Fed's hands are going to be tied, where even if the economy is cratering, if inflation is high because of the fact that the U.S. began to import tariffs to pushing up goods inflation in the U.S., then the Fed's hands are going to be tied. It's not going to lower rates as much as it would like. And yes, we've seen longer term yields coming down. There's no question. But part of that is also lack of demand for U.S. assets, U.S. treasuries, because of the fact that the U.S. is expected to run larger deficits, which had been pushing up yields in a higher inflationary environment. But now, like, the U.S. dollar is weaker. Like, people are not running to U.S. assets, investors aren't running to U.S. assets the way they had in the past when there's an economic crisis, because it's a stagflationary shock created by design by the U.S. administration. And so that weakens the value of U.S. assets, and is ultimately weakening the value of the U.S. dollar as investors are looking to invest elsewhere where they're going to have greater opportunity. I mean, we've seen the euro, we've seen the yen outperform against the USD. Like, who would have thought that investors would look to those countries as like opportunities versus the U.S.?
Well, that also indicates that outside, foreign investors are looking at the U.S. right now and saying, I don't want to invest in the States. I don't know what's going on. So why would I? That, of course, under that circumstance, the U.S. dollar is going to drop.
Absolutely. And that, you could say that's by design as well, to some extent, that when you apply tariffs to another country, the country applying the tariffs, they see their currency appreciate, because then there's suddenly less demand for the other person's currency, so the other country's currency. And so what this is doing is, by reducing demand, by reducing the value of U.S. assets and making the U.S. less wealthy, there's less demand for the U.S. dollar, which is forcing it to depreciate. I mean, it's a crazy idea. It's like, by design, I'm going to make myself poorer by appearing less competent and capable. Therefore, I'm less employable. I don't really like it.
Living in bizarro world. That's what this is.
And that's why I don't put a lot of credence on these kind of like these multidimensional chess theory.
Having said that, we are still living in the reality of the fallout from this. The markets were just in a tailspin. We've got corrections and bear markets for some indexes. This is hitting Canadians. It's hitting everybody. And we're caught up and having to now figure out, okay, what do we do going forward? Is this, we've talked tough about hitting back with our own tariffs. Is that the right strategy? And do you think that'll actually have that much of an effect?
I think that it is going to send a signal to the U.S. I think that's really what it's intended to do, is provide this political signal to the U.S. that we're not going to take this lying down, and also that we're going to respond in kind to what the U.S. does, and that we're willing to do that. And we're going to go through that pain on our end as well, in order to demonstrate our sovereignty and demonstrate our willingness to push back. And so when you look at the first round of tariffs in particular, the interesting thing about those is that they were very much focused on hitting U.S. export sectors, where Canada is the dominant purchaser of those exports. And so it was very targeted toward that, to have the maximum impact on U.S. exporters in those categories, in those export categories. Things like booze and that kind of stuff, right? Where like it's really tobacco, all of those sorts of things, where Canada's like, we're the primary importer of those goods, U.S. exports. The second round, I mean, obviously responding to steel and aluminum as we did before. But even in the other categories that we were hit with retaliatory tariffs, very much focused on those areas that are going to do the least damage to the Canadian economy. And so there's really been, I think, a very clear focus by the government of Canada to really try to both maximize the impact it has on U.S. exporters, these retaliatory tariffs, and minimize the impact on Canadians. That doesn't mean it's not going to come without consequences. We put out a note today saying, growth is going to be slower as a result of these retaliatory tariffs, and inflation is going to be much higher. Over the next year, it's probably going to be about 0.6 percentage points higher. So you think like that would mean inflation would be closer to 2% as opposed to 2.5% over the next year if it wasn't for these retaliatory tariffs. But at the same time, I think Canada's between a rock and a hard place when it comes to this. It's not the outcome we want, certainly, but we were dealt this hand, and we have to play it.
And this inflationary cycle isn't necessarily because of demand, is it? Typically, prices go up if there's hefty demand, but this is just the natural flow through of prices because of the tariffs.
Yeah, that's right. That's right. So, there are a few impacts, right? Like there's first on the consumer goods that we buy. They've applied retaliatory tariffs to food, that sort of thing. And then there's also the intermediate goods. So things that go into, manufacturing processes that then, go into exports that are sent back to the US or purchased by or elsewhere or that are purchased by Canadians. And so you do get this sort of long tail of inflation coming from these tariffs. Then you also get the weaker Canadian dollar that's coming from the trade war as well, right? Canada's been, among the worst performing currencies against the U.S. This year, and so and for good reason, right? So it's all of that plays into the higher inflation we have at home.
Do you think in the short term, gas came down because of the end of the carbon tax, and now it's dropping because of market forces? The price for oil cratering over Thursday and Friday. And that combined with, again, bond yields coming down and mortgage rates should adjust. Do you think that's any solace, if you will, for Canadian consumers that it's like, well, I can deal with higher prices for certain things because I'm getting a little bit of a break here? Or is that just a short term kind of a feel good because there's nothing else going on or nothing good to feel good about right now?
I think that's exactly right. I think that, the elimination of the carbon tax, whether you're supportive of it or not, I think is something that is going to provide relief to Canadians, certainly at the pumps right away and more gradually in a lot of other things that we buy, but certainly it's going to provide that immediate boost. I think the challenge in part is that, we had the rebate checks going to particularly disproportionately toward lower income households and middle income households. Now those rebate checks are going to be gone. Gasoline is disproportionately purchased, and even natural gas, that sort of thing, by more affluent households that tend to drive more, tend to have more vehicles, tend to live in bigger homes. And so ultimately, it's sort of, it's going to redistribute that benefit from, to some extent anyway, from the lower end of the income distribution toward the higher end of the income distribution. So there's going to be arguably even more challenges at the bottom end of the income distribution as a consequence of this.
We had the latest statistics in on the labor market, and the month of March was not great for Canada. 32 or 33,000 jobs lost, 60 some odd thousand plus in the full-time category were gone. It looked like the business was basically bracing for these tariffs, which started we're supposed to start in February, and then it kind of started in March, and now here we are. But at the same time, is that indicative in your estimation that our economy specifically is heading toward a recession, or you raised the word earlier, stagflation scenario?
Yeah, I think that, the March labor market data was a bit of a weird one. While we did get some weakness in it, it was concentrated in retail and wholesale trade, which I think could have more to do with the fact that you have the GST, HST holiday finally coming out of the wash in the labor market statistics in March. So I'm not sure how much we can read into this. Trade-sensitive sectors tended not to be as severely impacted as we might have assumed when we're waiting for the March data. But at the end of the day, it's not a good read, right? We saw that the unemployment rate ticked up overall, largely ticked up among younger Canadians, but ticked up nonetheless. And ultimately, we think it's going to continue to be headed in that direction. We haven't updated our forecast for the latest tariff news that's come out, but we're projecting back in March that we'd enter a recession likely in 2025, and that could come as early as the second quarter of this year as demand for Canadian trade, Canadian exports slows considerably. You get a lot of weakness in business investment, given that those trade numbers and the uncertainty. And then weak consumption as well as, the labor market softens and population growth slows. So there are a lot of headwinds facing the Canadian economy right now. So we think a recession is probably the most likely scenario around the middle part of the year.
And we're not that far away again, all of a sudden, from another Bank of Canada policy announcement, the 16th of the month. Kind of a 50-50 chance right now but the odds have been going up that they might cut for an eighth meeting in a row. I mean, if we go through another week like we just did, and again the subsequent economic signals start to show more specifics of a downturn, even with rising inflationary risks, does the Bank of Canada have to cut?
Yeah, I think that we haven't changed our call officially yet that the bank will stay on hold in April, because the bank is kind of stuck in a tough spot right now, right? It was waiting to see what these tariffs look like. And Canada, to some extent, got a bit of reprieve relative to other countries, at least on the day that they were announced, where, there's still USMCA exemptions in place, that sort of thing. I mean, the fentanyl tariffs are still there, but, generally, Canada didn't get hit hard again on Wednesday. And so
the so-called fentanyl, quote, tariffs. But having said that, Randall, the fact that when you're talking about steel, aluminum, and autos, those are pretty big components of the economy.
Absolutely. But the Bank of Canada has to contend with the fact also that, inflation expectations in Canada. So inflation was 2.6% at the last read. We're expecting it to be even hotter when the March data comes out. And, the bank inflation expectations are picking up, that consumers and businesses see more inflation ahead, and inflation on average over the next few years higher than the Bank of Canada's 2% target. And so the bank has to try to find this balance of supporting the economy that's hit with this negative shock, but also making sure that it keeps inflation anchored around its 2% target. And so it being hit with the stagflationary shock puts the bank in a kind of an awkward situation where it has to try to strike that right balance between keeping inflation as low and stable as possible, while at the same time helping to support the economy. So we think there are more cuts ahead for the Bank of Canada. We think they'll end the year at about 175 basis points by the end of the year, but we're not sure they can really go all that much below that. We'll see what happens. But even in our most pessimistic scenarios that we've published, we're closer to 150 basis points at the bottom, because the Bank of Canada has to contend with this shock. I'd say that the good thing that's happening or happened with the elimination of the price on pollution is that gasoline is the most visible price that consumers see. And we know from U.S. data, we don't have great data in Canada, but U.S. data, that gasoline prices tend to be the biggest driver of consumer inflation expectations. And so as we see gasoline prices come down, that might bring down those expectations for future inflation. And so that might allow the Bank of Canada to have a little more room to reduce rates and support the economy, as long as those are staying relatively well anchored.
I wonder as well, though, we've heard prior to all of this about the great mortgage reset. If you've got an economy that's slowing down, people losing their jobs, you could get into some real serious issues with the housing market. And would that be also something the Bank of Canada will be watching?
Oh, absolutely. I think the Bank of Canada was concerned when it first started cutting interest rates that it might supercharge the Canadian housing market. But we saw the data in February was abysmal, and the March data that we've seen so far for some of Canada's major cities suggests that it's going to be a very weak month.
Toronto had one of its worst months of March on record for real estate sales. I mean, it's supposed to be the spring season, and that's when things are supposed to start moving, but that is not the case.
That's it. And all we can really link, rates have been coming down, right? So all we can really link it to is the uncertainty that's happening around people's labor market prospects going forward. So it's a very challenging situation for households. And, we're expecting to see that, households, really tighten their belts and make sure that they're stocking away savings for what could be a pretty tough year or two ahead.
Listen, thanks very much for joining us today. I appreciate it. Rest up, because I'm sure you've been just over the keyboard writing up reports all week, as has everybody in the world of economics.
Well, it's always a pleasure, Mike. Thanks so much for having me.
And that was Randall Bartlett, Deputy Chief Economist at Desjardins Financial. I'm Mike Eppel. You can send us your feedback on this episode or any of the other episodes by emailing us at hello@thebigstorypodcast.ca or leave a voicemail at 416-935-5935. You can also find us on the Seeker app or on all of your favorite podcast players. On X, my handle is @Eppman. That's EPPMAN. Thanks for listening.